The crypto ETF world is exploding. Forget spot Bitcoin ETFs. There are now ETF buffer funds that limit losses while allowing most of the gain. There's yield funds that offer 10 to 50% income. There's options funds. There's 2 times leverage and inverse Bitcoin funds. And there's a lot more. Welcome to ETF Edge. I am your host, Bob Pisani, here to make sense of all of these new Bitcoin and other kinds of crypto ETFs. Ric Edelman, the founder of the Digital Asset Council of Financial Professionals. He's the former head of Adelman Financial Engines. And Ric, it didn't take us very long to go from spot Bitcoin to now we have buffered Bitcoins to leverage and inverse Bitcoins. Make sense of this explosion of new products. Well, some of them make sense, and some of them not make sense?
Some do, some don't, Bob. You're right. It was 14 months ago that the SEC said yes to the spot Bitcoin ETFs, and in less than a year they raised $100 billion in investor assets, the fastest growing ETF category ever. When you create that kind of liquidity, you naturally create an options market. Same thing happened in stocks. Not a surprise that it happens in crypto. And now you have an explosion of additional kinds of ETF categories. You mentioned some really exciting ones, buffer ETFs and yield ETFs. You can now invest in Bitcoin ETFs that protect you against the downside volatility while preserving your ability to enjoy the upside profits. Columos, Innovator are 2 leading ETF companies that do these kinds of things. You also have the ability to generate yield off of Bitcoin now, thanks to these covered call writing ETFs, just like you have in the stock market. And because the out-of-the-money calls are so extreme, you can generate massive amounts of yield, much more than you can in the stock market.
Yeah, so there's funds that generate income through covered call writing. This is we've had these for a while. This is similar to the S&P 500 funds.
Exactly.
JEPI, for example, which writes covered calls and you collect income on them. Grayscale has one, BTCC, Roundhill has them as well. What's the downside, though? You're limiting, you're selling calls, right?
Sure, so the downside is you're limiting your upside, but considering that the upside is predictably so high for crypto, limiting yourself to a 50% gain, that doesn't seem to be too bad a deal to me.
Yeah, and you can go long and short Bitcoin now. You pay some very steep fees here, but look at some of these ones. The volatility shares, 2x Bitcoin strategy, BITX is out there. I have problems with leverage and inverse. You know this. Yeah. 1.8% fees. There's a daily reset that people have a hard time wrapping their heads around.
Most folks don't even realize what that really means, Bob, and this is the biggest issue that we both share this concern about. These ETFs, these inverse ETFs, these leverage ETFs often have an assumption you're going to hold the fund for a single day, a daily reset. That's literally the same thing as buying a lottery ticket. This isn't investing. This is pure speculating, like buying a ridiculous speculative thing, and it isn't something that most ordinary investors should go anywhere near.
Right. And all of this erodes returns over time. Sure. High fees, daily reset, something like that. I guess the good news here is there's now very easy ways to allocate money to crypto, and for advisors, it's fully compliant. You're in an ETF format, right?
Exactly right.
The bad news is these are very complex products. You got very high fees, and you have very high risk. Right? I mean,
it's the same thing as you have in the stock market. You have some pretty secure, understandable, low-cost ways like S&P 500 funds, and then you've got funds that invest in penny stocks on an inverse leverage basis. So like in any investment category, you've got to do your due diligence. You have to make sure you understand what you're investing in. Avoid the get-rich-quick nonsense. Crypto is meant to be a long-term hold, just like the stock market. It's meant to diversify the portfolio, just like the stock market. And if you try to engage in a get-rich-quick, I'm going to make money on a free, risk-free basis, chances are you're going to get what you deserve.
It sounds like the same thing as investing in the stock market, essentially. You sound essentially like Jack Bogle investing in index funds.
And the difference,
you want to speculate, here it is, but you're probably going to lose money long term.
And on the other hand, if you recognize that portfolio diversification, portfolio rebalancing, dollar cost averaging, tax loss harvesting, all of this applies to investing, and crypto should be a part of that.
You have been an advocate of long-term index investor for decades, saying the average investor is better off in low-cost indexing for both stocks and bonds. You've also been a big advocate for crypto for a while. What is the argument that crypto should be a part of your overall investing portfolio, and how much? I know it depends on age groups, but give some advice. What are you telling your clients now?
Well, I'll give you 2 pieces of this. Number one, Bitcoin clearly over the past 15 years of its existence has been the best performing asset class in history, bar none. It is widely expected to continue that track record over the next 10 years. So on an attitude of trying to create wealth long term, crypto makes a lot of sense. Second, most importantly from an investment advisor's perspective, Bitcoin's price movements are independent of all other asset classes. The prices don't move in sync with stocks or bonds or real estate or gold or oil or commodities, and that makes it a perfect addition to a diversified portfolio. If you engage in rebalancing, which all investors ought to do periodically, owning Bitcoin helps to lower the risk of the portfolio while improving the returns. A risk-adjusted profile is one of the big claims to fame of adding Bitcoin to a diversified portfolio.
It's really the big claim for adding to anything. I mean, why do I need a new asset class? Okay, I have stocks, I have bonds, I have a nice fund for short-term money. I have a money market fund, and I have a little bit of gold. Why should I add Bitcoin? Your point is diversification, lower volatility, potentially adding to the returns. Those are good reasons.
That's all there is to it. In other words, if you believe in modern portfolio theory, if you believe in Harry Markowitz and his Nobel Prize-winning research that says investing is as much about risk as return, we want to manage that risk. We want to diversify so that we don't have 12 eggs in one basket, we have 12 eggs in 12 baskets. Well, if I can add a new basket, if I can further diversify my risks to protect myself on the downside while preserving my potential for upside, why wouldn't I want to add the newest asset class, the first one to be invented in 170 years? Last time we had a new asset class was the discovery of oil in the 1850s. This is a wonderful opportunity to further improve the diversification, and all the academic data tells us.
And what percentage are you advising at this point?
Most are recommending in low single digits, 2, 3, 4, 5% allocations. But if you talk to people who are deep into crypto, they're doing between 10 and 40% allocations to crypto.
Yeah, so it's a lot of risk there. Considering the volatility of crypto, it's a lot of risk.
If you recognize the investment potential, you recognize the value of rebalancing, and you can afford the volatility in the long term, it can make a lot of sense.
I want to move on, talk a little bit about, you talked about the 60-40 stock bond portfolio for a long time. You say it's dead.
Yeah.
But not because bonds have no value. Why is the 60-40 portfolio dead?
It's dead because of longevity. We are living longer than ever before as a species. Nowhere in human history have humans lived this long, and it's widely projected due to exponential technologies in biotech and healthcare, neuroscience, bioinformatics, 3D printing, robotics, and AI, that over the next 30 years, humans are going to be routinely living to age 100 and beyond. Run your financial planning model, assuming you live to age 100, odds are good you're going to run out of money. If you're going to die at 80, it's not a problem. You live to 90 or 100 or 110, it's an issue. Yeah, so you need to have more equities, 70% allocation, 80%, not 60-40, 70-30, 80-20, to make sure you don't run out of money.
This makes a lot of sense. I'm approaching 70. My long-term plan was to live to 90, and every time I talk to you, you tell me, Bob, think longer.
For sure.
Than 90.
Odds are going to be really good. By the time you're 95, you'll be healthier than you are today.
That'll be interesting. So the bottom line here, Rick says people need higher equity exposure and for much longer than most advisors have traditionally recommended. You know, a few weeks ago, I had Nate Conrad on. He's the, for those who don't know, he's the head of LifeX and LifeX ETFs. We had him on ETF Edge. They have a suite of bond ETFs they call longevity income ETFs. These are essentially bond ladders that pay out principal and interest over a defined time period. And I found it to be a fairly simple and elegant solution for people who want income, and I'm wondering, what do you think? What do they do, and are they right for income, right for investors seeking income?
I really like the idea. We recognize that if people are living so much longer, the big fear everybody has is running out of money. They want guaranteed lifetime income, and that's what LifeX is delivering. It's an incredibly boring ETF. They're buying US Treasuries. Period. End of story. And they're generating income from these that are not only generating you the income off of the interest from the Treasury, they're giving you a return of capital as well, thanks to the bond ladder. So you can buy a 10-year ladder 20-year, 30-year, 40-year ladder, so that no matter how long you live, you're going to get a monthly stable income from the safest investment in the world with an extremely high level of predictability.
And you can buy these in different maturities. So you can go out and you can buy one that's 10 years. It has 1 year, 2 years, 3.
How long
5,
do you
7,
think
10,
you need the income?
20 or 25 years. But looking at the 10-year, you own a bond ladder of treasuries that go out 10 years. You get an annualized yield. The target is 10%. And right now I did this.
Not a yield, but an income distribution.
Right, income, that's right, thank you. Right now it pays $493 a month for 10 years. 40% of that is sort of the yield from the bond, 60% is distribution of capital. And what's amazing is, in theory, I could do this at home. You and I were talking about this, but nobody actually does this. I could buy a bond ladder of 30-day, 1 year, 2 year notes going out 10 years.
You'd have to
split
buy
the 100,000 equally, and then collect the interest, and then just sell the bonds off. But nobody does that.
You'd have to buy 120 treasuries, going from 30 days to 10 years. What a nuisance! This ETF does it for you in a tiny little convenient package for 25 basis points.
Yeah. And they do it all for you. So here's the key point people have to understand. After 10 years, all the money is distributed.
That's right.
And you need to understand that.
There's no return of capital. You've already gotten it.
Right, it's giving you capital back. And you can, this is an ETF, so you can buy and sell this at any time. And the price of that may vary, but you can buy. And now, when interest rates change, what happens? I mean, essentially, you're buying a ladder that already exists.
It's not going to make any difference to your income stream. It would have a difference, an impact, only if you were to sell it. So you can either sell it if interest rates go down, or you can hold on to it if interest rates go up. Your income that you're getting, the distribution, isn't going to change. We're talking about $900 a month that you're going to get.
Yeah, that's for a $100,000 investment.
Yeah, and about $400 of it is interest, taxable. The rest of it is not.
Yeah.
So this is a very tax-efficient way to generate a guaranteed income for as many years as you want to guarantee it. It's an innovative idea that I think is going to catch on.
And these are government bonds. They're not corporates or munis. I gather they did that for safety. That's the safest thing. And you mentioned in the tax treatment here. When I pay taxes, I'm just paying taxes just on the dividend, right? Not on the
exactly principal. Right. So if the yield is in the neighborhood of 11%, or if the total distribution rate is about 11%, you're only paying taxes on about 4%. The rest of it's return of capital. So it makes it very tax efficient and a very good way to generate income for as many years as you want on a guaranteed basis.
So this might be even better to be in a taxable account rather than a 401k, for example.
I would agree.
Okay. And there's two flavors here. We have only gone over the plain vanilla one. There's also an inflation protected one as well. You get less return, but you get inflation protected. So how do you play off?
If you were going to go with a 10-year maturity, I probably would go with just the straight one that gives you a higher income. If you're going to go with the inflation adjusted, that would make sense if you're going to go with a 20 or a 30-year bond ladder. Either way, it makes a very easy way for you to generate a high amount of current monthly income for retirees who are looking for that benefit.
Now, and again, the inflation protected is based on changes in the CPI. But what if somebody dies before their term is over?
Well, it's like any other ETF. The money, the account just goes to your heirs.
It goes to your estate,
right? And
the heirs can continue to receive the monthly distributions
if they want,
or they can sell it. Right?
Exactly.
Okay. Let me move on because you've been doing some very exciting things recently here. In December, you ended your long-running podcast for many years. And you had a radio show even longer before that, but you still run the Digital Asset Council of Financial Professionals to educate people about investing in crypto. But you also founded a diagnostic research company. This is Doran. Now, tell us what you're involved in. This is fascinating research.
My wife and I have been involved in the fight against Alzheimer's for decades, and we had the opportunity to acquire a company that is doing some really innovative technological research in diagnostics of Alzheimer's disease. And we are hoping to launch a blood test that will be able to tell you 10 years prior to symptoms if Alzheimer's is in your future with 90-95% accuracy. We're hoping to bring that to the market within the next several months. We've discovered that our technology is also applicable for other neurological diseases such as Parkinson's. And we also now see that it has potential in cancer as well. So we're working very hard to develop this technology and bring it to market. And it's a very exciting
Do I want to know if I have a 95% chance
now
of getting Alzheimer's without any real cure immediately?
But there is benefit today. 10 years ago, I would have agreed with you. Why would I want to know if I'm going to get Alzheimer's? But today, we now know that fundamental lifestyle changes can help you delay and reduce the symptoms. changes in your diet and exercise, sleep, in stress. All of the things we tell you to do for your heart are applicable for your brain. So if you knew that you had this in your future, it might cause you to drink less and stop smoking.
Well, at least one of the two I might consider doing. I'm not a smoker, by the way. It is quite amazing, though, to see the research on this. My grandmother died of Alzheimer's, and my father was terrified of it his whole life, and he lived to 90. The only thing he did not die of was Alzheimer's, but he was terrified of it his whole life.
It's understandably so. None of us want that kind of a future, and yet it is very prevalent. We all know somebody who has or has had Alzheimer's. It's 100% fatal. It is the most expensive disease to treat because the average patient from symptom to death lives 12 years and typically requires 24/7 care. It bankrupts millions of American families.
You know, and I see what the effects of stress are on a lot of people, even myself. It sort of short circuits the brain a bit. It makes it harder to think, and I can't help but think there's obvious effects neurologically.
Sure. One of the things they're discovering are hearing aids. If you are hard of hearing, you're forcing your brain to work harder. If you get hearing aids, you reduce the effort on the brain, which can help reduce the onset of Alzheimer's.
That's amazing. Now, you've done other things. You just opened a fossil museum, the Edelman Fossil Park and Museum in Rowan University. This is in southern New Jersey. Suzanne, my wife, and I were there over the weekend. It was fantastic, a beautiful, interesting experience, literally on a fossil bed. 70 million year old fossils.
Most people don't realize that the very first dinosaur ever discovered was in Haddonfield, New Jersey, outside of Philadelphia in the 1850s. New Jersey is a hotbed for fossils, and there happens to be a quarry right there in Mantua Township where, now that we have the museum, you can go into the dig site, dig for fossils. Anything you find, you get to take home. It's a fabulous experience.
Yeah, and there's a virtual reality exhibit that's really wonderful. It takes you back to the Cretaceous period, literally, and it's very lifelike. It's amazing how far the technology on VR has evolved.
The museum is an awful lot of fun. I'm glad you enjoyed it, and we encourage everybody to go visit. It's a great time.
I want to move on and talk about financial literacy. This is something near to my heart and very dear to your heart. You've spent decades talking about financial literacy. I mean, how do you feel about the current state of financial literacy? I see surveys that indicate financial literacy levels seem to be a little higher, but then again, I see people investing in lottery-like behavior, and I don't think people are necessarily smarter than they were 35 years ago when we founded CNBC. What's your thoughts?
I'm afraid you're right. Both of us, of course, on the board of the Museum of American Finance, we spend a lot of time trying to improve financial literacy among American adults. We stink at it. Less than half the high schools mandate a course in personal finance for their students. Our parents generally don't talk about money. Our employers don't help us with money. The only way we discover the issues of money is through the School of Hard Knocks as adults, and we're over our heads when we're trying to buy insurance or buy a car or get a mortgage or deal with college planning for kids or writing a will. We're in over our heads because we're not taught this. And all the data shows that we're no better at it than we were a generation or two ago. We need to integrate the subject of money education, recognize it isn't about speculating on a get-rich-quick environment, but dealing with the fundamental issues of credit and debt, of dealing with wills, home ownership, paying for college, paying for a wedding for that matter, buying versus leasing a car. This stuff's not complicated. It's just that most in corporate America want to make it seem complicated so they can make you their hostage rather than their customer. This is why we've grown to love, and we love to hate, banks and insurance companies and credit card companies.
Are young people more inclined to engage in lottery-like behavior, as we said, which is roll the dice, let's bet on all the money on Bitcoin or all the money on Nvidia, or is it because there are vehicles that enable them to do that now that they didn't used to have before?
It's a little of both. You have companies like Robinhood, which was infamous for the confetti every time you made a purchase, that triggered the parts of your brain, just like the triggers affection for drugs. On the other hand, today's youth are looking at their parents and grandparents and recognizing how poorly prepared they are for retirement, and today's youth are saying, I don't want that to be my future. Just like I'm looking at my grandfather who used to drink and smoke a lot and how bad his health is, I'm not going to drink and smoke like he did. Youth today are more interested in the world of money because they do realize the importance of it. Their challenge: they don't make a lot of money. And if you don't make a lot of money and you're struggling to pay your bills, there's not a lot of money left over to save and invest.
Seems to me like the young people today are a little better at savings than we were in the 70s. We did very little. My generation, I'm the classic baby boomer. my generation did very little savings, and as a result, we didn't start saving money into our mid to late 30s.
Well, we didn't know we needed to, because we were the first generation as boomers that was going to live as long as we are. Everybody before us, our parents, grandparents, and elders, they all died in their 50s and 60s. You didn't have to plan for your future. You weren't going to have one. But our children and grandchildren realize, I am likely to live to 80, 90, 100, and I better take this seriously.
Yeah, that makes me very happy when I see young people doing that. At the same time, though, I see them engaging in this lottery-like behavior, and you want to say, why don't you take a little cue from the rest of us?
When so many of them
things.
are getting their financial education from TikTok, that's a little scary.
Yeah, it is, certainly. Rick, always a pleasure chatting with you. Thank you very much. That does it for this week's ETF Edge. My thanks to Rick. Now, I've asked him to stick around just for another 5 minutes to provide some broader insight into ETF trends. Yes, he's an expert in this area as well, coming up on the ETF Edge podcast. And remember, you can see all of our shows on our website. That's etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.